Hey, Keith here for Am I Rich? And today, do we have a doozy for you? Yes, the blue and gray mountain company called Iron Mountain. Yes, they are under the ticker symbol IRM. And what do? Well, they are considered a storage company, but what they really do is they grab documents from clients, corporate clients, and they store them for the clients, and the clients can access them, and they pay fees for access, and they pay fees for storage. The other business that they do is they shred paper, and they also have more recently storage for e-documents, whether it's scans of old documents on servers or the cloud storage that you can just transfer electronically. Now, this company has moved to a REIT structure, which means they pay out a lot of their earnings in dividend. So this company is currently sitting at a stock price of $35, and that gives them a PE ratio of 27.5, and a forward PE ratio is estimated at 31.1. A price to book ratio of 5.2. Now, these are all fairly high numbers, so it's got to have something else to it. Now, it does. Of course, I mentioned the dividend, and the dividend is 7%, which this is an amazing dividend for many companies. So if this can be a safe dividend, then this is definitely a company to think about. Now, if it has, it also has a 5-year growth rate, I should say, and the 5-year growth rate has been about 16.4%, which has really made me intrigued about this company, because they're basically building their intrinsic value at a faster pace than the market in general, and they have a really great dividend. So it's something that's very interesting. Now, recently they also had earnings come out, and they've done really well in the last quarter. That might be the explanation of why the forward PE is a little bit higher, suggesting they might not be able to maintain those earnings. But at the current value, I do see this. Now, you might think price to earnings, price to book, it's like when you open one of those Storage Wars lockers and you see, like, okay, this old safe or this old, doll, this is worth nothing. But somebody else has thought this is worth a lot. And so this is definitely the case for Iron Mountain stock. They are considered to have kind of a moat, I think, and so this is why people have been paying a premium for this stock. And the current stock price is lower than what has been very good for the company as an average price that people are willing to pay. So relative to what people are willing to pay, I do think this stock is cheap at the moment. Now, that said, if people suddenly get a different image of this company, that could change how it does for its stock price. Now, the moat that this company has is that it is a very well-respected company among large corporations. I think in the Fortune 1000, it has over 70% of the companies in the Fortune 1000 that use Iron Mountain. It has virtual monopolies in many locations across North America. So it has that kind of moat. There are companies who just love to put their documents away and store them for 7+ years, and they forget about them basically. And they could throw some stuff out, but they don't. And so this is really great for Iron Mountain. So I think those are parts of the reason they have a moat. And I also think it's part of the positive or bull thesis on this stock. So if this company is able to maintain its growth, if it's able to surprise again with its growth, I see the stock price improving very likely, at least in the next year. I don't know about the next 3 to 6 months, but I do see it probably in the next year going up. And then assuming they don't have like major fallbacks in their earnings, if they do surprise a little bit, I think it'll probably go up. And then they have this moat with the big corporations. They have a really great dividend, and they also charge these fees, and corporations are willing to pay for them. So they just have this kind of business model that it's not expensive enough for corporations to go somewhere else, and corporations don't think about their old documents that frequently, so they're willing to just forget that it's there and just keep paying the bills. Now, that said, that kind of gives a possible negative scenario to this whole company. So that would be people might start getting rid of their old documents, and therefore less need for storage space. The new companies are currently more and more using just electronic documents for their actual document needs. And so I do see a trend, which really should have happened 25 years ago or more, but a trend towards moving documents on PDF, etc. And so they won't need as much storage. And so I see that as a downward kind of trend for Iron Mountain, which they are trying to address with their cloud storage and their server storage, I guess, very similar. Now, that said, that might be a good strategy, but it also might not work, because I can also see other competitors potentially arriving. If most documents go electronic, it wouldn't be that hard to imagine somebody like Microsoft, who is very well entrenched in all the major businesses as well, with basically Windows and other Azure cloud computing capabilities. It wouldn't be hard to see them, or maybe Amazon or somebody, basically store documents as well. So I do see those as major, things to worry about for this company. And also there's two other negatives that I see about this is their payout ratio, which should be high because of the way they're structured. It's a little bit high, so it doesn't allow very much wiggle room. So if they have a lot of issues happen in 1 year, say, a warehouse or two burns down, or lots of debt comes for some reason, they make some kind of weird acquisition, then I can see them not having much wiggle room to maintain this high dividend. And also, I see them having a lot of goodwill in their price. So, if they were able to write off a lot of their goodwill, you could see them suddenly not have as good of a financial position. So those are the kind of things on the negative thesis. Now, I do think this is very cheap. I do see this as almost a monopoly at the moment. I see corporations basically not transitioning that fast. So I see a lot of big corporations keeping their documents with Iron Mountain for the next 5 to 10 years at least. Then at that point, they might have scanned them, they might have transitioned, they might have realized they're wasting too much money, and so it's cheaper to finally transition to a new medium, and that might get rid of Iron Mountain's advantage. So I guess the play on this would be, can you get enough out of the dividend or the stock appreciation in that time before the company kind of dwindles in obscurity, or maybe they'll even have a plan to adjust, and maybe their cloud service will do well. It might. So those are the kind of ambiguous questions I have, and for those reasons, I do see the stock price is cheap at the moment. It just went up recently, so I don't know that it will go up for the next 3 to 6 months, probably the next year. But because of that, I'd say this is a hold for me. I wouldn't buy at the moment. And there are some very real risks to this stock long term. I don't know about the short term, but if the long term becomes a little bit closer, or there's headwinds coming more soon, then people are going to maybe panic, and the stock price could react quicker than the actual company does. So that's kind of the way I see it. I'd love to know, do you guys think Iron Mountain is a good company? Do you think it's really it's the gem that you find in the storage locker, or is it just a risky bet on a dividend? So yeah, I would love to know what you guys think. This is basically my thoughts, and that's where I guess we'll end. But thanks for watching, and we'll see you in the next video.